If you're thinking about buying a newly constructed home here in the Phoenix area, this is a video that you must watch because there are some things that the builders are not necessarily offering up as information that you need to know when buying a brand new constructed home. By the way, right now, that is a popular thing because people love new construction to begin with. And on top of it, they're offering some lower interest rates on their mortgages. So we're going to dive into all of these things that you need to be aware of, these 5 specific things when buying a newly constructed home. Let's dive in. But first, if you want to call and have a conversation with me right now and just skip the rest of the video, you can just go and do so by reaching me at the contact information below or booking a appointment on the Calendly link below on my calendar. And if you don't mind, just check out our Google 5-star reviews. We have over 440 of them right now that are from clients, hopefully just like you, that gave us a real rating and review of our experience in working with them. So check it out right there. Okay, back to the video. The shocking secret number 1 is loan fees. Well, Kelly, everyone knows about loan fees. This is true. Everyone knows there are fees associated to getting a loan on any property, but why are these somewhat shocking? Well, it's because right now, the hot button with new construction is that builders are offering rate buy downs with buying a house through them. Now, what is a rate buy down? Okay, right now, it's no secret that interest rates are pretty high when it comes to buying a home. We're talking 7% plus right now on getting a mortgage when you go to buy a house. But what are the home builders doing? What they're doing is they are offering a rate buy down. So how that works is this. Let's say you go in and you buy a house and you get pre-qualified through a lender. Well, if your pre-qualified rate is 7% based on your financials and your FICO score, your debt to income ratio and all those things, then what the lender is going to do is say, well, you're pre-qualified for 7%, but we're going to give you a rate buy down that we as the seller or the builder, we're going to pay for it for you, so it's no cost to you. And so we're going to give you a 2-1 rate buy down, which means for the first year, your rate is reduced 2 percentage points down to 5% for year 1. And then after year 1 is up, if you do nothing, it's going to reset to a 1 percentage point reduction to 6% for that second year. And then going into year 3, it's back up to the fully indexed approved rate of 7% for the remaining 28 years of the life of the loan on a 30-year fixed. So you say, well, that's interesting, but that's only temporary. That's correct. It is only temporary. So what you are doing is essentially you are subsidizing your monthly payment to be lower for that period of time, hoping that the Federal Reserve reduces rates at some point here in the near future, and you can refinance into another 30-year fixed loan that is obviously fixed for 30 years at the lower rate because, let's say, the Fed drops rates a half point, a point and a half, whatever you think may happen here in the future. So obviously it's smart not to buy the house if you can't afford the fully indexed 7% rate and whatever that monthly payment ends up being, but it does give you some temporary relief coming down to 5% or 6% in this example. Well, the builders are not dumb. They are offering that as a marketing incentive to get you to buy their house. And how do they do this? Well, they can do it because they own the mortgage company under the big umbrella as the builder. So not only do they have the building division as being a home builder, but they have a mortgage division as well. What they're doing is they're taking less profit on the house and they're shifting that over to the mortgage side. So either way, the builder still is going to win, but they can afford to take a little less profit on one house to make sure these properties are selling so that the shareholders, if it's a publicly traded company, which most of these big home builders are, remain happy and the stock price remains high. So when you walk into the new home construction model home, you see all the flyers and the marketing saying that they have a rate buy down, or just how would you like to have your interest rate be 5% or whatever it may be to get you to go, that sounds interesting. Let me find out more about that. And then you start talking with them, you find the generalities out about the loan. But what they fail to maybe include on the upfront marketing, obviously the disclosures have to be in there at some point when you sign documents, but up front, you may not get the whole story that with the conventional financing, you're going to have mortgage insurance if you don't put down at least 20%. See, that mortgage insurance payment is going to depend on how large your loan limit is, therefore how much money you're putting down. And as a conventional loan, if you're putting down 3%, 5%, 10%, or anything less than 20, you are going to have a mortgage insurance payment every single month until your LTV or loan to value amount gets to be 80%, or to be technical, 78% after the fact. So without getting into too much weeds on this and how that works, just know you're going to have an extra payment in addition to your principal and interest payment on top of that, as well as taxes and insurance. But we'll get to that in just a second. Oh, and HOA. But we'll get to that in a second as well. Buckle up and stay tuned because we're just getting started. And if you're a buyer that's going to get financing through FHA, then they sometimes fail to let you know about the funding fee. Funding fee, what is that? That's right, if you're getting FHA, FHA has insurance on that because you're only putting down 3.5% for an FHA loan. And that funding fee is 1.75% of the price. So if you're buying a $500,000 house, that is equivalent to $8,750 that is a charge to you at closing. Now you can roll that into loan in many cases, so you don't necessarily have to write a check for it, but you are paying for it either way, and it's something that you need to be aware of. But what if you're a veteran and you want to buy a house? First of all, if you are, thank you very much for your service to our country. I know myself and most Americans, the vast majority, are extremely grateful for your service to our country, and thank you for that. But if you want to buy a house, you can get a Veterans Administration loan, a VA loan. That is a benefit that you have as a veteran for serving in our military. So how does that work? Well, if you do that, there is a funding fee for VA as well that will range between 1.25% up to 3.3%, depending on certain things like the size of your loan amount, etc., etc. But the VA loan is awesome because it allows veterans to not have to put any money down. That being said, you still have that funding fee that will roll into the loan if you don't write a check at closing, which ultimately affects your monthly payment. Now, there are some waivers on this based upon disability, if you received a Purple Heart and things of that nature, which is awesome for the veteran. But again, just know, generally speaking, there's going to be a funding fee that's going to affect your monthly payment if you're getting FHA, VA, or conventional and are putting down less than 20%. So that wraps up the loan fee section as to what the builder may not just offer up to you as the information when you're calculating your monthly payment. But again, at the end of the day, they have to have disclosures and you will sign documents. But if you don't have a realtor with you when you go to work out all these deals when looking to buy that newly constructed home that knows what they're doing, you may just go ahead and sign documents blindly because you're probably not going to read, like most people, every single line item of every single document on that thick document set that you'll be signing when you go to purchase your house. But that's what we're here for. We're here for you and your best interest. We truly are as realtors. We've represented hundreds and literally hundreds of people who have purchased newly constructed homes here in Phoenix over my 19 years of selling real estate in this area. So give us a call. We'd love to help at 480-660-5974. Okay, now quick sidebar. Who pays the fee that goes to the buyer's representative or agent when it comes to a newly constructed home? Great question. See, how this typically works is when a builder goes to buy a big plot of land, and then of course they close on it, and then they start dividing it up and entitling it, and the infrastructure is put in, they have a plot map of how many lots they know they could put on this big plot of land that they are purchasing. Well, when doing their pro formas and their financial analysis, they obviously account for many different fees and costs associated with developing this whole parcel of land all the way until closing of every single lot with every single homeowner. Well, one of those line items in that pro forma that they already account for are broker commissions for the buyer on that side. And so this is already accounted for, and they know that if they pay X amount of fees for broker fees for all these lots, they know, does it still work? Does it still meet our shareholder expectations? Do we still turn a large profit? And if the answer is yes, they buy the land. They're not going to just buy the land and not know that, well, if an agent comes in to represent this buyer and this buyer, no one comes in. They don't work like that. They have to have certainty in terms of what they're doing, because we're talking millions and millions of dollars that they're putting on the line to develop this whole subdivision, this whole parcel of land. So generally speaking, it's already accounted for when it comes to all the broker commissions for buyer representation when purchasing new constructed homes. So it does not cost the builder any additional money to pay the buyer agent's fee when it comes to the representation of making sure they have a great experience and they get the house they want for the terms they expect. So please know, if you call us, if you contact us to help represent you when buying a new constructed home here in the Phoenix area, there's no additional fee that you have to pay or no additional fee that'll be tacked on to your price when you're looking to buy that home. So just food for thought that you're not being put in a disadvantage financially by having a buyer's agent represent you at the model home when you go to buy the house. In fact, it's literally just the opposite. And if you get the right agent who will be involved in the process like we are at Cook & Associates Real Estate Advisors, then you'll have a phenomenal experience when it's all said and done and you get the keys. The second secret that we are talking about here that builders necessarily don't offer up out of the gate are taxes. That's right, property taxes specifically. So again, the marketing collateral will talk about how low your monthly payment will be, and it'll talk about how the rate buy down will get it to where it needs to be, but they may not offer up, by the way, guys, you have property taxes you got to pay, and it may be X amount of money. Because if they don't offer up this information because you're doing your own due diligence, you have to remember that the builder's representative that sits in the model home, they work for who? The builder, and the builder alone. They have their best interests in mind, not yours. And so you're gonna have to do a lot of this due diligence on your own. Well, what you'll find out is that if you do some research, you may see with the property taxes, because remember, property taxes are paid in arrears in the state of Arizona, that it's an extremely low amount. Now, mind you, property taxes in Arizona as a state are extremely low compared to the rest of the country. In fact, on average, the state of Arizona's property tax assessed rate is around 0.6, which is extremely low compared to, again, most states across the country. But if you look at the amount that is actually going to be assessed, right away, you're looking at the dirt, the lot, just your lot. What's that worth, the value of that? And therefore, it's going to be a much lower amount because we're not even taking into consideration the rest of the value of the improvement on the land, which is the house. And so if you calculate your monthly payment based upon a 0.64 percentage rate, which is the average for Maricopa County, and you base it just off the value of the dirt because maybe that's all you find that's listed, you're going to be in for a rude awakening the following year when you look at your tax bill and your monthly payment on your house went up because your property taxes went up dramatically because now they're assessing the entire value of everything sits on the lot. So a little food for thought that you need to be aware of. And another thing too as well, a lot of the new construction that's happening is happening in the West Valley and the East Valley, primarily Southeast and the Southwest. Well, in the Southeast and the South, you now start running into a situation where you may purchase a newly constructed home in Pinal County, not Maricopa County. See, the town of Queen Creek actually borders the county of Maricopa and Pinal. In fact, you may have a Queen Creek address down there, but yet you're in the county of Pinal, which is a different tax rate. See, Casa Grande, Santan Valley, parts of Queen Creek, and the city of Maricopa, not the county, the city of Maricopa, all for the most part are located in Pinal County. Now that tax rate is higher than Maricopa County. That tax rate is at 0.75%, whereas Maricopa is at 0.64%. So if the builder doesn't offer this information up gladly to you so that you can factor that into your monthly payment, you will get a tax bill, whether it's just the dirt or it's the approved value on the land. Either way, that's why property taxes makes the second thing that you need to be very aware of when calculating and trying to figure out on a budget what your monthly mortgage payment is going to be. The third secret that you need to be aware of that could affect your monthly payment that builders may not offer up to you is the CFD, the Community Facilities District. Now, what is this? Okay, guys, so in short term, that is a tax. Wait, I just thought we just talked about property taxes. We did. This is an additional tax on your property taxes that will show up on your property tax statement, as you can see an example on the screen right now. The main cities that have the CFDs throughout the Phoenix area are Scottsdale, Peoria, Mesa, Buckeye, and Goodyear. But you do need to check with your local real estate professional to find out if the new build you're looking to buy actually has a CFD, because they can be in other suburbs as well. Now, why is this a thing? This is a thing because the developers of these neighborhoods and these big parcels of land got together a long time ago, matter of fact in 1988, and they passed legislation that passes on the cost of all the infrastructure when developing a new parcel of land for a community. And so what happens is there's a tax for X amount of time, depends on the town, depends on the development, until a homeowner, which actually accepts the burden of it on their property taxes, helps to pay that off, which usually can be a lot of money over a long period of time. So before you jump into writing that contract, you need to make sure if the property you're looking to buy is in a CFD and what that amount might be. In some cases, it could be around 1%. So picture you buying a house for $500,000. Well, 1% is $5,000. Divide that by 12, and that's about $416 a month that'll be tacked on top of your taxes that you already have to pay to subsidize the CFD. And you don't have an option. If you buy the house, that's part of the deal. So again, another nuance to just be aware of that your local real estate professional can help you with when it comes to buying that new constructed home. The fourth secret that a home builder may not be willing to just offer up to you is the rising cost of homeowners insurance. Okay, so now you're going to the builder, you're all happy, you see the advertisement for the low interest rate on your loan, you're trying to figure out some basic math, and then you get to the closing table, fast forward, and you're there, and you see that your monthly payment's not anywhere close to what you thought it would be because one reason, homeowners insurance has gone up dramatically. Now, this is not a home builder issue in their defense. This is an issue that everyone has to deal with when they're looking to buy a resale or a new constructed home. But homeowners insurance has risen dramatically. In fact, 72% of all homeowners said their insurance increased over this past year, while 8% said their insurance carrier dropped them altogether, and 9% on top of that said they are worried their insurer may actually drop them as well. And over the past several years, from 21, 22, and 23, insurance rates have gone up over 20%, with an expected 6% increase in 2024 alone. So this makes the cost of owning a home even more expensive on a monthly basis because insurance costs are going up dramatically. And because we know we live in the desert here, when it rains, the ground is decomposed granite in most places and it doesn't soak up the rain very well. And so therefore, there's a lot of places throughout even the Phoenix area that are located in flood zones that you shouldn't have to worry about too much because the developer should handle all the retention of that water throughout the neighborhood. But you have to be aware of that because if you're in a flood zone, you may have to apply for flood insurance. Now, flood insurance is not that expensive in terms of additional cost on top of your normal homeowner's insurance in the Phoenix area, but it is an extra cost and it is something that you need to be aware of when looking to purchase a newly constructed home. And the fifth and final thing we'll talk about, which is not just limited to these 5 things, but the 5 main things I want to make you aware of on this video are HOA dues. That's right, guys. HOA dues are pesky and they are increasing as well across the valley in most areas. So not only do you need to find out what your HOA dues are on a monthly or quarterly basis, but you also need to find out what the fees associated with the HOA and living in this neighborhood are going to be. Now, if you're in a gated community, it's gonna be a little more expensive because typically it's a little more of a higher end community with more maybe community areas, retention areas, pocket parks, things of that nature, but also the maintenance of the gate, they charge you for that as well. And of course, if it's guard gated, then it's way more expensive because you're helping subsidize the cost for the guard at the gate when people are coming in and out of the community. But in a normal community, you're also going to have an HOA for anything that's built new, that's built by a builder or a developer. And so you need to find out what the fees are going to be when you buy the property and when you go to sell the property. And the builder may not be willing to just offer that up to you right away, even though obviously it's going to be disclosed at some point before you buy the house. But the big one to be aware of is that some communities, not all of them by any stretch of imagination, charge what is called a community enhancement fee. Now, typically that enhancement fee is found on the larger master plan communities. But what that is a large fee that somebody has to pay when they buy or when you go to sell your house. That fee usually ranges from 3/8 to 1/2 of 1 percentage point of the purchase price of the property that someone has to pay one time when the house is transferred or sold between buyer and seller. So for example, if it's 1/2, 1 percentage point in the community that you are owning the house in, when you go to sell it, it's going to be $2,500 for one fee when you go to make that transaction. So it's something you need to be aware of that you may not be fully offered up that information when you go to buy this house. And there are other fees when it comes to selling a house as well, typically in most HOAs. A transfer fee is usually on most transactions, and usually it's the most least expensive fee, usually in the ballpark of a couple $100s. But there's also another set of fees, usually under the label of a capital improvement fee, could also be called working capital fee, and I've seen other labels as well, that can be a little more expensive as well, sometimes in the ballpark of $700, $800, $900. It just depends on the specific community. But the point is, you need to be aware of these because these will all affect your fees when you go to buy or sell the house, as well as your monthly fee in terms of how much the HOA is on an ongoing basis. Now, also, if you choose to work with a good real estate professional that is knowledgeable and full of experience with good relationships with these builders, and you go to buy a house, a lot of times we can negotiate certain incentives for you that the average person won't ever know that you received when you purchase your house. Why? Because they're not public record. The final sales price is public record. All and any incentives are not. So for example, speaking of HOA dues, one thing we like to do is possibly negotiate a year or even 2 of HOA dues paid up front by the builder so that you don't have to pay HOA dues for a year or 2. That is real tangible value. Now, there are other things that we do as well, and things that we won't even go into detail on this video, but suffice to say that it is very important to have representation when you go to buy a newly constructed home, especially if it's from a realtor who has experience in knowing all the little intricacies and nuances of making that purchase, that transaction. So feel free to give me a call. I would love to chat with you further about new construction or anything else real estate related in the Phoenix area. You can reach me at 480-660-5974 or just reach out to the contact information below. And I love to spend some time with you because we're passionate about all the research and all the details to make sure you have a great experience and you don't ever get surprised when it comes to the 11th hour when you're at the closing table getting ready to sign a document, or even worse, several years later after owning the home. That's what the position you don't ever want to be in. So if you wouldn't mind, just go ahead and subscribe, smash that like button, and get us out to more and more people that could benefit from this information. And to see more videos about everything Phoenix, click on our playlist right here. Oh, and don't forget to call.